Are you ready to build a better road to wealth for you and your family? Are you ready tonight to learn just some of the myths the academics use to manage your money that may keep you from outperforming? Well, stay tuned with us tonight for this edition of The Master of Money. Tonight's Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. Tonight's special guest is Mr. Jeff Garbaz, Principal of Quantitative Partners. This Master of Money program was produced Tuesday, March 24th, 2015. Hello, everyone, and thank you for joining us on this edition of The Master of Money. I'm Steve Beeman, your host, and on a personal level, I want to thank you for taking the time to join us. I do want to make a point to everyone, though, and just so you know, if you're not able to watch us live some evening on our Tuesday night program, you can always watch the archives of The Master of Money that we store up on our Safe Financial Network at Ustream. To get to that site, just go to Safe Financial Net, click on The Master of Money anytime, day or night, and that will take you right to all of the archives of The Master of Money, as well as our Safe Insights. So it's a wealth of information you can get there, available to you 24 hours a day, 7 days a week. So thanks once again for joining us. Tonight, I'm going to get a little more technical than we've been lately, and I'm going to talk about two of the underlying academic theories that drive the investment process many, if not most of you have in your portfolios. They're called the efficient market hypothesis and the corollary to that, the efficient frontier. These are academic theories that for 30 years have driven investment management, and tonight I want to explore those with you and see if in fact they're helping you or if they're setting you up for a trap that could close on your investments and hurt you if things change. So stay with us. This should be a very relevant program, especially if you've got a 401k plan you're managing. Now, last week, you may recall we touched on the psychology of investing, and that was a favorite topic of mine because as I've traveled around the country over the last years and spoken to many, many folks, I find that one of the drivers that prevents people from acquiring wealth is their own self-perception. And part of the Master of Money is to help people let loose of those self-perceptions so they can build a path to prosperity for themselves. But as important as it is to understand it, we sometimes have to change our behaviors and our self-image in order to start to receive that path. We want to help people with that, and that's what that program was all about. Needless to say, if you have a situation where you think something like that's happening to you, write us at questions@safefinancial.org, and I'll make sure to get right on the phone with you and see if we can't help you explode some of those self-limiting identities. Now, this week in the question area, we had a young lady write us, and she's a nurse who just went through, very sadly, a divorce. And we all know that out of divorce, there are no winners, there are only survivors, and this woman certainly seems like one of those. She's putting her life back together, and she said, Steve, I love watching the program, but I'm just starting out. Where do you think I should begin? Well, we had a nice chat, and it seems that she has a 401k at her employer. So the first thing I recommended to her, that I always would, is that she take the opportunity to put as much as she can into that 401k, and also take as much of the matching funds that her employer offers. You know, a sad fact, for every 10 people I talk to who have a 401k open to them, only about half of them actually take the matching funds. Folks, it's an immediate 100% return on your money. Take the matching funds. But once you begin to do that, we then talked about the 401k Active Watch process that's made available through our friends at Harvest Financial Services, and how that 401k Active Watch could actually help her monitor the mutual funds in her portfolio. Critically important that she learn how to do that, and so we were glad to have that discussion. So if you've got similar questions, as always, write to me at questions@safefinancial.org. And again, I want to thank our friends at Harvest for making 401k Active Watch available to the society and to its members. It's very, very important stuff. Now, moving as we do into the geopolitical world, I thought one of the most interesting things to make you aware of is a move by China to create something they call the Asia Infrastructure Investment Bank. Now, this Asia Infrastructure Investment Bank is a new central bank, in essence, for Eurasia. They're using it for Hong Kong and for China. They're trying to elicit the support of Japan and even Australia. Now, this is part of a very conscious move by the Chinese to make their economy the globally most important economy. In fact, if you travel around China, you'll see billboards that talk about China becoming the world reserve currency. This is demonstrably bad for the United States. We don't want to see our dollar lose its status as the reserve currency. So we want to be aware that China is making inroads into this, and they're trying to do it so they can get better pricing on imported goods. Obviously, the petrodollar, which is a United States-based oil currency, is critically important that we keep it on the dollar. Most countries pay far more for their oil than we do. We don't want to lose that. And so our policies in the United States need to make sure we maintain a strong dollar so that we can fend off the attacks from the Chinese. The second thing, in continuing with the situation in Europe, they had massive riots break out in Frankfurt, Germany. But surprising, the Greeks are the one that may disavow this debt they've got and go bankrupt on it or just not pay it. But in Frankfurt, believe it or not, the people were rioting against the European Central Bank that loaned the money to begin with. It seems that those rioters didn't think the European Central Bank was justified in being part of this troika to put on the austerity measures in Greece. Well, I don't know about you, but if you're not paying your bills, you've got to, and Greece needed something, so I don't know outside of austerity what their plan was. But anyway, the rioters were quelled quickly by the Frankfurt police, but it shows you the insecurity in Europe right now. And for all of us who have portfolios of global stocks, Europe is an enormous trading partner and a big impact on the world. In fact, just a side note, it's important to note that as it relates to the Ukraine, that embattled nation between Russia and Europe, Putin and Russia actually went direct to the Germans and the French to ask their support for creating a peace program in the Ukraine. Now, you might ask, what's so big a deal about that? It bypasses NATO. And that's been Putin's long-standing objective, to isolate the United States by devaluing the NATO partnership. So it's a very important thing to keep an eye on, as Europe is hugely important to our economy, and we want to make sure that we're as close to them as we can be. In the United States economy, we had the Federal Reserve meetings last week, and coming out of what were really mixed economic signals, we're getting a sense that the Fed is very hesitant to raise rates in the near term. When I say near term, I mean in the first or second quarter. They seem to want to hold off until the third, and you could see the markets react to that with a nice bump up. The reality is, no one knows when the Fed is going to do this. We know they want to. We know they're in a pickle. They kind of have to. But until we get a signal from the Fed on exactly when, we're still staying in the market. We're just making sure those risk controls are there in the event they change their mind. But keep an eye on the Fed, as always. And our friend Doug Roberts, who wrote Follow the Fed, we follow Doug very closely because he's in tune with what's going on with the Fed governors. So stay tuned always to the Master of Money to hear what's happening in that world. Another interesting note as it relates directly to our economy, the Saudi oil minister came out and said he doesn't foresee $100 a barrel oil at any time in the future. Well, we've talked about this a lot. In fact, I've been on a number of television news programs talking about oil prices. I believe with all the fracking technology, that, again, this is huge in the United States. We've become energy independent because of fracking technology. But recognize globally, the United States only has 10% of global oil reserves when you consider fracking. So there's a lot of capacity out there for oil. So I think the Saudi oil minister to say $100 oil is out of the sight, I think 60 might be out of sight. We're down below 50, around 46 and change. I think we're going to stay there. You've got some people saying we'll go down around 20. Again, others saying 60 to 80. I think we stay in the middle of the distribution and look at around $40 a barrel, which means to you and to me in the United States, gasoline between $2.20 and $2.70 a gallon, somewhere in that range. In the Midwest, we saw a little blip up this week, but that's because of the reformulated gas that we have to use every spring. it causes a supply disruption, so gas prices rise in the near term, but they should come down. So again, on the oil side, I think we're going to see stable prices in the 40-something dollar range. I don't think we're going to see wild swings anyway anytime soon. So enjoy those oil prices where they are today. In the financial markets, as I said, we had a really strong week. We saw the Dow clear the 18,000 mark, the NASDAQ cleared the 5,000 mark, and the S&P 500 cleared the 2,100 mark. All very nice moves supported by this continued zero interest rate policy of the Fed. Now, as you know, we talk about it every week. We keep an eye on those interest rates because when they move, the market will probably give back. But there's no indication they're going to do that right now, so the markets stay very, very strong. Now, as we get ready to go to our break, there's one other story I want to share with you. I was on a news program recently talking about food safety in America, and we were talking about simple things. I don't know, if you eat tilapia, something on the order of 80% of all tilapia that we eat is manufactured in China or grown in China. But it's interesting to note that Chinese farmers won't even allow their children to eat some of that fish because of the antibiotics they use, because of the artificial fertilizers they use. Some of the really unhealthy things we would never allow in the United States are prevalent in Chinese goods. And in a study I saw just this week, the total of 48% of food imported from China was considered unacceptable. Now, I say that to you, when you go out to the store, if you're buying fresh fruits, if you're buying fresh seafood, if you're buying food that's from China as its originating country, you might keep an eye on that and beware. I'm not sure I'd want to be eating all those pesticides myself, but we know that everybody has their own preferences. So if you like it, you can eat it. Now, again, when we come back tonight, we're going to talk about two of the most important academic theories there are, the efficient market hypothesis and the efficient frontier. Many of the advisors that you have build you portfolios based on these two academic concepts. They're hugely important in the industry. They've been around for 40 years or so. They were Nobel Prize winning theories when they came out. It's very important that you understand the efficient market hypothesis and the efficient frontier, because it's from that target date funds are built, stable value funds are built, and many of your portfolios are built by your investment advisors. So stay tuned tonight as we explode the myth of those academic theories and show you just why they might be setting you up for a bubble. So stay with us as we continue tonight on this edition of The Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to this edition of the Master of Money program. I'm awfully glad that you're staying with us. Again, I mentioned to you earlier that all of the Master of Money programs are archived up on our Ustream channel. It's called the Safe Financial Network. You can access that channel through our website at www.safefinancial.org and just click on the Master of Money and it will take you right to the Ustream page that we feature our archives. In addition to the show that we have up there, by the way, we also have our Safe Insights. These are topical things that we produce periodically, about once a week, and they cover important issues that we can't cover in the Master of Money. So check out the Ustream page. It's called the Safe Financial Network. A major question that you have to answer and that all of us in the industry answer is the market efficient? It's a huge question. Do prices reflect accurately all of the publicly available information and indeed all of the information related to a security's valuation? Well, this was the hypothesis of Eugene Fama of the University of Chicago when he published the efficient market hypothesis. He won a Nobel Prize for this, and the argument was that the market is efficient. And a guy named Burton Malkiel wrote a follow-up book called A Random Walk Down Wall Street, really stating that you can't beat the market, that all the information is in there, and that no one really has information that isn't publicly put into those prices already. So the efficient market hypothesis is the genesis of the index funds, for example, where an index fund assumes that you can't actively trade in order to beat the index, so you might as well just capitulate and buy the index as a whole. Well, a lot of people have done that, and a lot of people have been hurt. We'll talk about why in just a minute. Because what that does is goes to the second corollary, which is called the efficient frontier. Now here's the thing. This was created by a guy named Harry Markowitz. And the efficient frontier looks at this concept of risk and return. And remember, we've talked about this before. The efficient market hypothesis holds that a stock is efficient and inefficiency or volatility is quantified as a word called beta. That's this instability of a stock price. Well, the efficient frontier looks at the returns of these assets, like stocks and bonds and cash, and then looks at the beta or the volatility of the stocks and bonds and cash. Here's the underlying concept. It's pretty easy to grasp. The more money you make on an investment, the more risk you're going to take. For every unit of risk you increase, every unit of return you get in return. It's pretty simple, right? So what they've done is taken the efficient market hypothesis and the efficient frontier and created investment products from them. They seem prima facie or on the surface to make perfect sense. But as I'm going to show you, some of that work is biased in the time period in which it was built. And we can see this playing out today. And if you have investments in your 401k or with your advisor that are based on this efficient frontier, I want you to take tonight's program and rethink the nature of those. And let me tell you why. This theory holds that, again, things have risk parameters. Cash, for example, has no risk. So if you put money in the bank, you have no risk, but in return, you get virtually no return. Bonds have a little more risk and a little more return. Stocks have a little more risk yet and a little more return yet. As a result, the efficient frontier portfolios have weighted portfolios. In other words, they've put the amounts of money in those baskets that the frontier thinks is appropriate to maximize your return to risk relationship. Let me be specific, because it seems common sense. If we take a portfolio, a typical person who's 40 years old, the efficient frontier would tell them, for example, to take 10% and put it in cash, to take 50%, say 60%, or say 50, it makes the math easier. Say 50% and put it in stocks, and take the remaining 40% and put it in bonds consistent with their age. I think I mentioned to you one night the legendary investor John Bogle, founder of the Vanguard Group of Funds, one time said that for every year and age that you are, you should hold that percent in bonds. That's based on this concept of an efficient frontier. So that 40-year-old has risk exposure of 50% of their portfolio in stocks, 40% in bonds, and 10% in cash. Now let's take that portfolio forward to someone who is, say, 60 years old. Well, they might have 10% in cash. They might only have 30% in stocks and 60% in bonds. The idea being, as you get older, you want to take less risk. We're not as much worried about return as we get there. We're more worried about risk. And that makes perfect sense to you and me. There's no question about it, right? As we begin to approach retirement, we don't want to risk our money and lose it. So the efficient market hypotheses all say the same thing. Migrate toward bonds as you get older. Again, carry that forward. The 70-year-old has 70% in bonds, the 80-year-old 80% in bonds, etc. Now, here's the issue. There are literally hundreds of billions of dollars invested like this. Many of you watching have heard of or are invested in target date funds. This is how a target date fund works. It simply looks at your age and then it allocates your stock, bonds, and cash allocations based on your age. Again, it makes sense on the surface. You and I could sit here and we could say this is something that we could support. But here's the next addition to it that I want you to think of. That research was done in a period from the 1960s up until, it was originally done in the 60s, but let's call it from the 60s to the 2000s that it held true. What does that time period have in common? It's very simple, declining interest rates. Since certainly the late 70s, so go back to 1980, we have been in a systemic declining interest rate environment. Well, as a result of that, as interest rates came down, stock prices went up because with the rates coming down, the competition for return favored stocks, and bond prices went up because as yields went down, those holding the higher yielding bonds were able to sell those for a gain. So this concept of the efficient frontier played out for everyone. Stocks went up, bonds went up, because we had that common thread of a declining interest rate environment. Well, as you and I have talked, in fact, we talked in the earlier part of the program tonight, the United States now carries about 110% of its gross domestic product in debt. So our public debt is about 18 trillion, our GDP is about 16. What that means is that eventually the Federal Reserve, our central bank, is going to have to raise rates in order to keep stability in the dollar. Again, earlier in the program, I spoke to you about China that is making very serious inroads into trying to become the world's reserve currency. Well, the fact is we want the dollar to be the world's reserve currency, so we need a strong dollar. That means eventually this zero interest rate world you and I have lived in will go away. The problem with that is, as interest rates go up, two things are going to happen. Stocks become less attractive because the interest you can get on a loan is more attractive, so stock prices will begin to come down. That's why the markets are so scared about this and so skittish. But by the same token, and this is where these efficient frontier portfolios are going to get hurt, as those rates go up, bond prices come down. We're now in a situation where rates can't go any lower. They might stay steady for a long time at zero. They could do that. Japan saw that. But they're likely going to go up. So if you follow these efficient frontier portfolios, you're loaded up with bonds right now at the worst possible time. It's a trap awaiting hundreds of millions of people. Now, the solution to this is to seek return, but it's to do so, in our opinion, through moving to a tactical management approach. The markets today are much more liquid than they've ever been, and the trading costs today are much less than they've ever been. So you can trade in and out of baskets of stocks using exchange-traded funds for very low trading costs, where you could never do that before. So if we go back 20 years and we want to put in a tactical trading strategy, the cost of trading it was prohibitive. You'd have lost money because of it. Well, now, because trading costs are so low, you can be in the markets and out of the markets with virtually no slippage. Now, we don't believe in market timing. I never have. I don't believe you can predict if the market's going to go up, sideways, or any other way. But I do believe that by looking at certain momentum characteristics, you're able to identify when a market is ripe for expansion or it's ripe for deflation. And I think using this, you can put risk controls onto your money so that you don't get hurt by major changes to the market that happen quickly. If, for example, play out the scenario with me, Greece defaults on the debt. The European Central Bank is now out, I don't know the number, $40–50 billion. As a result of that, they're going to have liquidity problems. That will ripple through the world like nothing. So all of a sudden, the U.S. Federal Reserve is going to be saying, well, we better step up and add liquidity. Well, if they add much more liquidity without raising rates, the dollar starts to deflate. This is a real issue. And if that happens, the markets will react very quickly. If you have risk controls, and again, going back to this idea of momentum characteristics that you can put in to protect you, as the market comes down, you'll be out. It's not timing, it's reacting to the market, but you're doing so in a way that protects the downside of your portfolio. As I've said to you, if you go talk to the major hedge funds, you talk to the big time investment players, all of them do the same thing. They don't like to lose money. Well, neither should you. And just being long a mutual fund because, oh, over time they go up. No, they don't, not necessarily. You've got to learn to be more active in your investments, and I would urge you to find an advisor who can help you do that. Clearly, if you don't have anyone in mind, write us at questions@safefinancial.org, and we'll work with you to find one in your area who can actually support your portfolio in a risk-managed environment. This is important stuff. Again, if you're retired and you're protecting your wealth, or if you're in pre-retirement, that 55 to 65, write me a note. Let's talk about how we can structure your portfolio to maximize that return. Now tonight, we have an opportunity once again to go to our friend Jeff Garbaz and talk about Superstock Investor Report. We're going to talk about some of the stocks we've been in and where we've made some money. It's always nice to get a hold of Jeff's take on the market. So right now, let's go ahead. Jeff, welcome to the program.
Steve, thanks for having me back this week. I thought I'd deviate a little bit and kind of talk about bracketology. Yep, it's that time of the year where March Madness takes hold and everyone focuses on the NCAA tournament. So people may be asking, what does March Madness have to do with making recommendations to buy stocks or options? The answer is it has everything to do with being a successful investor or speculator. First off, let's take a look. How many of you thought when you did your March Madness bracket you're going to get all 63 games correct? I hope nobody listening really thought they were going to get all those games correct. The odds of doing that were about 128 billion to 1. Warren Buffett, the Oracle of Omaha, knew this, and last year wrote insurance that that would not happen. The only reason he didn't underwrite it again this year is there's now a lawsuit over who came up with the idea. In fact, last year only one person on all the major websites out there got the first round 100% correct, but in the second round, that person went down in flames, losing 6 games out of the 16. So, what do we take away from this? The point is that no one can predict with 100% accuracy March Madness or anything close to that, and no one can predict the stock market with 100% accuracy. Let's just take a look at what happened last Wednesday. Last Wednesday, coming into the FOMC, the Federal Reserve Open Market Committee meeting, that the market was down 16 points. It reversed and it finished up just shy of 2,100. And now we're a week later, and we're basically at that same level. We haven't gone any higher or any lower since then. A lot of people might have thought, okay, this is going to be a seminal Fed moment, and we're going to take off like we did in Jackson Hole when Bernanke spoke and the market went up for 3 months in a row. Guess what? That didn't happen. So how do we look at how successful we are? We call this the batting average. What's our percentage of winners to losers? In my 2 option services, I come in at 79 and 83%. In our 1 stock service, we're at 73%. To beat the S&P, you need to be right about 55% of the time. So I'm pretty happy with those statistics. Another statistic I like to look at is my average return per recommendation, and also what my typical drawdown is. Why am I talking about these statistics? Well, my favorite team in March Madness is the Wisconsin Badgers. I live in Madison, and I follow Bo Ryan. Being a former Division III basketball player, I love the fact that Bo Ryan came from Division III, coaching at University of Wisconsin-Platteville for 15 years. And he was a very big statistics guy. He loves to look at statistics. And his record, something north of 700 and less than 240 losses, validates looking at statistics. So a great statistic that Bo likes to look at is the points per possession. That's similar to our average drawdown. And how many points are you getting out of each possession? What I'm trying to instill here is that you need to, when you're looking at your portfolio, evaluate it and come up with some statistics to track how you're doing. And let's say like they're playing a team and their point possessions went down. He would then try and make adjustments. Another key concept to portfolio management is making adjustments as necessary. If you don't make the adjustments, then you get in trouble. And an even bigger way of getting in trouble is going off of intuition. You need to come to intuition by looking at the statistics. So as an example, I have a very good handle on the current move in the markets. We're now in our 9th day of moving on the S&P 500, up day, down day, up day, down day, up day, down day, up day, down day. And in theory, today would be an up day. We haven't had a streak like this in quite a time. So it's very interesting to see these type of things moving. So what have we learned from this? No one can be 100% successful, and we need to look at statistics to analyze how well we do. Next week, we'll get back to talking more about stocks, but I thought this would be a nice way of looking at March Madness and the stock market. Thanks for having me, Steve.
Well, thank you, Jeff. It's always nice to hear from him. Again, I've known Jeff for many, many years. Back in the 90s when I had Chicago Investment Analytics, Jeff and I worked very closely to take that research into institutions, and it's nice to hear that he's doing so well with Superstock and his other things. So as always, again, I thank him for participating. Next week, when we come back, we're going to have more ideas to share with you on how you build your path to prosperity. It is the singular mission of the Society to Advance Financial Education to help you build a road to wealth. We think you deserve it, and we want to help you get there. As always, we hope you'll visit our sponsors, Harvest Investment Services and Superstock, and we look forward to seeing you next week for another edition of The Master of Money.